Part 1 for Chapter 2, The Accounting Cycle. And there are 2 parts for this chapter. You need to memorize the accounting formula, or make sure you memorized it, which is assets must always equal liabilities plus stockholders' equity. You also need to remember the accounting cycle. You start with analyzing financial transactions associated with the company, then you journalize, then you post in the general ledger, then you prepare an unadjusted trial balance. You mainly do this to see if if your debits equal your credits, and to analyze the accounts themselves, because then what you're going to do is you're going to adjust for deferrals and accrue revenue and expense accounts. Remember, adjusting entries only done at month end never involve cash. Then you're going to prepare an adjusted trial balance. Now you do this at the end of the month. Then you're going to prepare the financial statements. You start with the income statement, then you do the statement of stockholders' equity, then you do the balance sheet, and the last one is the cash flow statement. You close out, this is only at year end, you close out your nominal accounts, and then you prepare your third trial balance, which is your post-closing trial balance, which should only reflect balance sheet accounts. Now, let's take a look at the rules for debits and credits. Debit and credit are neutral terms, not good or bad, mean either a decrease or increase depending on the type of account and where it is on the accounting formula. Now we'll take a look at exactly how that works. Now, assets. You increase with a debit, you decrease with a credit. Dividends, you increase with a debit because they reduce stockholders' equity, and you reduce with a credit. Expenses also decrease stockholders' equity even though they're on the other side of the formula, so we increase with a debit and decrease with a credit. Now, which accounts do we increase with a credit? Oh, before we do that, remember, how you increase an account is always called the normal balance. So, when you see these on the financial statements, it is assumed they have their normal balances, or they would be shown with brackets. So remember that. So, dividends. Normal balance is the debit and expenses. Now we'll take a look at the accounts that increase with a credit. That would be liabilities, decreased with a debit, common stock, increased with a credit, decreased with a debit, returned earnings, increased with a credit, decreased with a debit, and revenue increases with a credit. Now, however you increase them, remember again, now you need to memorize this, is always what we call the normal balance. Now, we're going to take a look at what we do. We have the general journal, and that's where we show both sides of every financial transaction. We write the account debited first and the amount in the left column, and we write and indent the account credited next and the amount in the right column. Now today, this is all done on the computer. Debits must always equal credits when you do the journal. Then we post in the general ledger. We're going to transfer the information from the journal to the individual accounts in the general ledger. The general ledger, the collection of accounts and their balances. Now we're going to walk through the journal process. Now we're going to go through this one a little more, because what we're going to do is I'm going to show you my thought process whenever a journal entry is required. First, I determine which accounts are affected. So for this example, we were paid in advance for services we're going to provide in the future. So we haven't earned the money, so it's not revenue. So cash and unearned revenue would be involved in this transaction because we received $25,000, but we haven't done the work. We haven't done the work. Next, that's going to help us determine the type of account and if they increased or decreased. So, the cash is an asset and it increased because it went up. We received the cash. The unearned revenue is a liability and it also increased because now we have unearned revenue on the books. We didn't have it before we received the money. Now, based on the rules, how would you journalize the transaction? The asset increases with a debit and liabilities a credit. Now we can do our journal. We're going to debit cash and we're going to credit unearned revenue. So that is my step-by-step process I go through in my head every time I do a journal entry. Now we have some more transactions. We purchased $1,000 of supplies on account. On account means no cash changed hands, so since we bought something, it would be an accounts payable. Perform $10,000 in services for $5,000 cash, and the balance is to be paid in 15 days, or we can say the balance is on account, which means that we didn't receive the other $5,000, which means we're now going to create an accounts receivable. And we would book this as sales revenue. Next, we paid $500 for the supplies bought on account. So now what we've done is we have reduced our accounts payable and we have reduced our cash. So accounts payable is going to go down by $500 and cash is going to go $500. So now let's look what this looks like when we post it to our general ledger. So first, our first entry was we received the $25,000 cash and we have unearned revenue. Our second entry was we bought supplies on account. Our third entry is we did some services and we were paid $5,000, but we also set up an accounts receivable for the balance. And then we also, our last entry was we paid $500 of the accounts payable that we owed for the supplies we previously purchased. Based on this information, we now can do our first trial balance. This is our unadjusted trial balance. It's a list of all the accounts in the general ledger in financial statement order, starting with assets. And this is what our first trial balance would look like right now. You cannot use this one to prepare financial statements. Next, we're going to do adjusting entries. These are only done at the end of the month. They're required because of the revenue and expense recognition principle. Never involves cash. There are three types. We have deferrals. These are already on the balance sheet, but we've either earned the money or we've consumed the item. Example would be for earned would be earned revenue, and for the other part would be prepaid rent. That we now, time has gone by and now it turns into an expense. Accruals, these are not on the books at all. And for these, what we're going to do is record them for the first time. An example would be is we did work, but we didn't have time to put it on the books. So then we would have, and we didn't get paid. So that would be an accounts receivable and it would be service revenue. And then, of course, we have depreciation, amortization, and depletion. So first we'll take a look at deferrals. These are already on the balance sheet. And we're going to transfer amounts to the income statement. So office supplies of $500 were consumed of the $1,000 originally purchased. So we're going to book it as an expense and take it out of supplies. Notice no cash. Next, we earned $10,000 of the unearned revenue. We're going to take it out of unearned revenue, which is on the balance sheet, and put it on the income statement as sales revenue. Now accruals, these are not on the books at all. We had salaries of $600 earned by employees, was not recorded, salary expense, and salary payable. So it would go on the income statement and it would go on the balance sheet. And then last, we had sales made on account for $1,500. It would be accounts receivable and sales revenue. Now we post it to the general ledger. There's our $500 in supplies that transferred out of an asset account and became an expense. Assets become expenses. Unearned revenue, we had a liability that becomes revenue. And we have our salaries payable. And then we have our revenue that we earned, but we hadn't had time to bill, so we set it up as an accounts receivable. Now we can do our second trial balance. This is the adjusted trial balance. It's prepared after adjusting entries are posted and lists all the accounts from the general ledger in financial statement order. You use this trial balance to prepare the financial statements. Here is our example. Now this is our adjusted trial balance. And now we can use this to prepare an income statement, a balance sheet, a statement of owner's equity, except we don't have one in this case. Now the last thing we're going to do is closing entries. This is only done at the end of the fiscal year, normally December 31st, or the operating cycle, whichever is sooner. And in this case, there's only done after financial statements are prepared. What we're going to do is zero out all the nominal or temporary accounts. These are revenue and expense accounts, also dividends. So, first thing we're going to do is we're going to figure out our balances. And then what we're going to do is identify our temporary accounts, which would be sales revenue, supplies, and salary expense. Now we can do our journal entries. The order is we always start with our revenue accounts. What we're going to do is debit the revenue accounts and credit retained earnings. Then we're going to do our expense accounts. We're going to credit the expense accounts and debit retained earnings. Then the last thing we're going to do is we're going to zero out our dividends account and take that as a debit to retained earnings. Our closing entries would look like this. Our sales at revenue would go to retained earnings. Now the difference between these two should be our net income. Now we can take a look at what that looks like. So here we go. We have transferred our sales and zeroed out that account. We've zeroed out supply expense and we've zeroed out salary expense. Now we can prepare our last trial balance. And that is the post-closing trial balance, and it should only show balance sheet accounts, again in financial statement order. And this is what it would look like for our example. So as you can see, our debits equal our credits. We have actually rolled into our returned earnings account all of our expenses, revenues, and dividends. And if you notice, the ending balance is $20,400. That ends this part one of a two-part presentation.